Hi there, quick question. How big of a role do you think investors' emotions play in the price movements of a market? Well, think of your answer and then let us know at the end of the video after we talk about the psychology of a market cycle. Okay, let's define some terms first. Market cycles. What are they? Well, market cycles are trends that emerge during difficult markets or business environments. They're usually the period between two lows or two highs. For instance, at the time of this video, we may be in the beginning, middle, or even the end of a market cycle of a certain asset. Investors try to analyze market cycles to decide when to enter into a market with the goal of making maximum profit. Though these patterns are tricky to identify, especially when you're in the middle of it. All right, now that you have a rough idea of what market cycles are, let's take a look at market psychology. What is it? Well, it is the idea that the movements of a market are influenced or reflect the emotional state of its participants. So think of Bitcoin's last bull run, for example. Many people had positive sentiments towards the digital asset, right? Well, usually positive sentiments go hand in hand with a rise in demand, and as an effect, the prices also rise. Now, of course, the reverse is also true in that negative sentiments about an asset cause its demand to reduce. So, how do emotions change during the market cycles? Well, let's dive into the 14 stages of the psychology of a market cycle. And we'll use this chart right here from Wall Street Cheat Sheet as a guide. And as you can see, the y-axis represents the price of the asset, while the x-axis represents the time or the ongoing period of the cycle. With that said, let's take a look at the first stage, which is disbelief. This stage comes after a bear market. At this point, moods are low and investors are skeptical about rallies and run-ups, thinking that the price will eventually fall back down. But it doesn't. The asset steadily maintains its upward trend, and now there is a little cloud of optimism among investors. This leads us to stage number 2, hope. At this stage, optimism grows even further. Now, from the chart, you'll notice that the price may be moving up, sideways, or even down sometimes, but there is still a belief that recovery from the bear market is possible, and the overall upward movement of the price will hold. This marks the beginning of a bull market. All right, now on to stage 3, which is optimism. At this point, there is a solid belief among many investors that the upswing in prices is real. So notice from the graph how prices are rising quicker than before. Towards the end of this stage, investors are ready to act on their sentiments. And when they do, we usher in a new stage, belief. This is where investors, even the ones that were skeptical, start making their comeback into the market. There is a real belief here that this is indeed a bull run, so it's time to finally invest your money. And after some time, it does pay off. Investors get real profits, and this marks the 5th stage of the cycle, which is thrill. So this is typically where you would start to encounter like experts on YouTube, TikTok, you name it, telling you how much they invested and how much profit they got, and now everyone and their grandma can do just as well investing in Bitcoin and whatnot. And so as a result, more people, even those with little to no knowledge about the asset, jump on the bandwagon due to FOMO. The price rally might continue and new all-time highs may even be hit at this point of the cycle. This stage is called euphoria, a stage filled with a lot of self-patting and fantasies of riches. And this stage may mark the end of the bull run. And now the prices may start to steadily fall, bringing us to stage 7, complacency. Now remember how there was disbelief at the beginning of the cycle? The same thing happens at this stage, only that this time, some investors don't want to believe that the recent high prices were the end of the bull run and are still optimistic that new highs are coming despite the recent drops. But the drops become more evident and anxiety sets in among investors as the recent price pullbacks now evolve into a downward trend. Regardless, there still may be a hesitation to sell, and this hesitation breeds stage 9, denial. At this stage, investors are like, I'm holding good long-term investments anyway, so I'm just gonna stay in the market no matter what. But as the prices continue to plummet and seeing that fellow investors are selling, panic sets in. Here, investors start considering getting out of the market and salvaging the capital they have left. They may still be 50-50 on whether to sell or weather the storm by sticking to the initial hodl game plan. But as prices continue going down, the game plan is thrown out of the window, bringing us to the 11th stage, capitulation. Investors finally decide to sell due to fear of losing their whole capital. After selling, the investors may be dealing with many emotions, but the prevailing one is anger. They start asking questions like, who made me lose all my money? How did this happen? And they grow angry at whatever they believe caused the bear market and the loss of their gains. And when there are no answers to these questions and the realization that even if there were answers, things couldn't be changed, the cycle gets to stage 13, depression. So at this point, investors blame themselves for giving up all their bull market profits by not leaving the market in time. Though, finally, after the bear market, the prices start to rise, marking the end of the old cycle and the beginning of a new one. So a good example of how prices affect market psychology and vice versa is Bitcoin's bull run in 2017. So let's bring up the chart and see what went down during that period. Bitcoin kicked off the year trading at around $900. 6 months later, the price had doubled. And in December, Bitcoin was trading at a new all-time high, $20,000. But this was short-lived, as less than a month later, Bitcoin lost half of its value. At this point, we're in the second half of the market cycle. Bitcoin's price continued to fall in 2018 until a new cycle began in 2019. While people who entered the market early may have made some profit regardless, investors who got in late, say at Bitcoin's peak in that cycle, would have suffered significant losses if they decided to sell due to panic. All in all, the whole idea is to use this cycle to choose the best time to enter a market. And this could be when people are selling. However, this may also backfire if the prices continue to plummet, leading to losses. And mainly, it's just because it's much harder to understand how the market is changing as it goes than it is to look back at market cycles and recognize how the overall psychology changed. So, remember the question that I asked you at the beginning of the video? Well, I'm wondering, do you believe that investors' emotions play a part in how the market behaves? Well, make sure to let us know what you think in the comments. And of course, also remember to like, subscribe, and follow us on all our socials for future alpha. See ya!